Hey, what's up, everybody? It's Tuesday, September 7th. Okay, we had a pullback today in the Dow Jones, the S&P. NASDAQ was up, gold down about 37 bucks. Those of you who have my report, you know I wrote in it yesterday that we have been seeing swap dealers. Those are primarily the big Wall Street banks. They've been aggressively shorting into the gold rally over the last week or so. So gold was ripe for a pullback, and we saw that pullback today. But having said that, I will also say that there's solid support underneath the market because we've seen gold producers buying now every time the market pulled back. So I don't expect this gold correction to go very far. It should have a limited downside, but it was totally foreseen. It was totally predictable just based on what the swap dealers were doing. Bond yields up, okay? Now, we have an auction, 3 auctions this week. Today we saw the 3 years, actually that went off pretty well. Tomorrow the 10-year Treasury, and then on Thursday the 30-year. So this is typical when you see Treasury supply these auctions. It's typical that, you know, we get a pullback. It could be dealers just marking down price to get a better price. It's just supply. You know, and it's that background fear of the Fed meeting this month and what they're going to say. I don't really pay much attention to that because Fed is not going to raise rates. And that would be the key thing that we need to see for any prolonged rise in interest rates and bond yields. And that, you know, the Fed already said, I mean, they're not going to raise rates till, you know, way out next year, if not 2023. We had that weak job report on Friday, and I talked about that yesterday. I mean, at 235, that was way below the forecast. I think the forecasts were all off, but 235 in the pre-pandemic world, like before the pandemic, I mean, everybody would have been cheering that number. Everybody would have been saying how strong that number was. If we had Trump still in office, he'd be tweeting about that all day long, all week long. So that's just like a pre-pandemic reading. And again, I've been talking about fiscal flows slowing down. We're looking at GDP for the third quarter coming in at 3.6 or 3.7. That would be down from a 6.5% rate in the quarter two. I mean, that's like a 40% deceleration in economic growth. I mean, that's significant, okay? Now this week we're going to start to see the numbers in the daily Treasury statement, and it'll let us know just how significant these unemployment cuts are, all right? So I'm going to keep track of that, and I'll be able to see that day by day to see what's happening. But like I said yesterday, I don't see the fiscal pump, that monthly spending, going much below $600 billion a month. I mean, that is still huge. August ended at $630 billion. We're going to go down. I mean, 10 million people now are off of those supplemental unemployment benefits. That equates to something like a $12 billion a month cut in those transfers. So what are we going to be down to, like 619, 620, 615, even let's say 600 billion? That is huge, all right? Because pre-pandemic, I told you, I looked at 5 years from 2015 all the way up to March 2020, the average monthly net spending by the federal government was $420 billion. So even with the cuts, we're still 50% higher than that. I mean, it's huge. It's huge. But I think the stock market has to pull back to reflect slower earnings growth. I mean, when you reduce fiscal flows like that, you're going to reduce the growth rate in corporate profits. And I think we're up here, near record highs. And as a matter of fact, NASDAQ made a new record high today. I don't think the stock market reflects that, the slowdown in the growth rate of corporate profits. I mean, it doesn't mean we're going into a recession. It doesn't mean that there's going to be like a market crash. But I think it has to pull back to reflect the slowdown in those fiscal flows. And I think that's going to happen. And I think this is the start of it. Again, we saw the Dow down today. We saw S&P down today. I have like a defensive position on. I'm actually short a little bit the market. So we'll see what happens with that. I really think there's going to be a pullback because the market is not reflecting that slowdown in the growth rate of GDP. And ultimately, that's where the market goes. It is a reflection of what's happening in the economy. If the economy was going into a recession, you'd see the market really come down. All right, corporate profits would drop significantly. The market would react to that, and it would reflect what's going on. Like I always say, you gotta follow what's happening with basic conditions, basic economic conditions. And I don't think that's reflected right now. So I think, and by the way, a pullback would be healthy, and I would love to see a pullback that took the market beyond what is justified by the fundamentals. Again, we're not going to see the fiscal flows decline much below 600 billion, if at all, per month. So, I mean, if we get a significant correction in the market, that creates an excellent buying opportunity. All right, you're going to hear a lot of, all kinds of negative stuff. It's going to be about the taper. It's going to be about Biden. It's going to be about Afghanistan. It's going to be about inflation. Like every excuse in the book is going to be thrown out there, and people will be like, yeah, it's this thing, it's that thing. But I mean, the fiscal support is still going to be there from what I can see. I mean, you would have to make significant reductions in things like Social Security, all the meds, Medicare, Medicaid, and the COVID and the pandemic payments tied to that. You would have to make significant cuts in defense. I mean, these things are just not going to happen. Now, we still have the deficit, the debt ceiling hanging out there. I mean, I've been talking about this almost every single day. And I guess Treasury right now operating with its cash balance and also extraordinary measures. We can go into October with what they have now, and then we have to see what Congress does. It's really up to Congress to raise the debt ceiling or suspend it or something. But again, I don't see any political movement on that whatsoever. Not even the Democrats in that 3.5 trillion infrastructure. I don't even think the debt ceiling is included in that package that they're trying to pass, which I don't even know if that's going to pass, because you got some of these, centrist Democrats that don't want it, whatever. So that may not even pass. I don't know. But even so, 600 billion a month, come on. I mean, 2 years ago and way back before then, 400 billion, we're up 50% from that. I mean, it's huge. It's huge. So I'm looking for a pullback in the market. I think it is not reflecting right now the slowdown in GDP. They're looking at a third quarter GDP growth of 3.6% annualized. That's down from 6.5%. And dollar was stronger today. I mean, you get that reaction on when the risk assets pull back. That's like a safety reflex, people moving into the dollar, but the dollar's fundamentals are not bullish. I'll say this again for the umpteenth time. The long-term fundamentals of the dollar are not bullish, with fiscal deficits and trade deficits. I mean, it's just not. And so that's the update. I did my podcast today. I will post it tomorrow. I will remind you. In the meantime, don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. I'm the only one who has an applied approach to MMT. I take the concepts and understandings of MMT and I use them to invest and trade in the financial markets. See you tomorrow. Bye.